Welcome to Retribe. Let me ask you a quick question. Have you ever noticed that making $1,000 in the stock market feels completely different than earning that exact same $1,000 at your 9-to-5 job? It's thrilling, right? It feels like free money. But here is the brutal truth. Treating those two identical amounts of money differently is exactly the kind of psychological trap that keeps the middle class broke. Today, we're going to break down how the wealthy actually view their money, and it all starts with understanding a massive behavioral flaw called mental accounting. So let's dive right into this.
Wait a second, John, I got to interrupt you right there. As an average investor, I was always taught to organize my finances. Isn't it just smart budgeting to separate your money into different buckets? I mean, I've got a vacation fund, a retirement account, my monthly salary to pay the bills. Isn't that just basic common sense?
Rachel, it absolutely sounds like common sense, but it's actually an incredibly dangerous cognitive bias when it comes to investing. What you're describing right there is literally mental accounting. Nobel laureate Richard Thaler, who's a huge pioneer in behavioral economics, defined this. It's the tendency for people to separate their money into different, non-fungible accounts based on entirely subjective criteria. So things like where the money came from or what it's supposed to be used for. And this brilliantly illustrates where the average person goes completely wrong when trying to build actual wealth.
See, the average investor is constantly labeling money by its source. They're thinking, okay, this is my hard-earned salary, this over here is my year-end bonus, and oh, this is my lucky crypto windfall. They literally attach completely different emotions to each pile of cash. But a wealthy investor, someone who is actually applying millionaire logic, understands a core economic principle. All money is completely fungible. A dollar is a dollar. It spends exactly the same way, and it carries the exact same weight in your total net worth, totally regardless of how you got your hands on it.
Okay, I definitely understand the theory behind that, but I need to see this in practice. Can you walk me through a real-world example? How does treating money differently based on its source actually destroy someone's wealth over time?
Absolutely. Let's look at number 1, the house money illusion, gambling with your gains.
This is a devastating consequence of mental accounting, and it usually starts when an investor experiences a sudden, unexpected gain in the market. It basically mirrors casino psychology. Let's say you bet $200 and quickly win $5,000. For a novice, that $5,000 just feels like house money. It doesn't feel like their actual hard-earned cash yet. So instead of securing that wealth, they immediately start taking high-risk, completely reckless bets. They don't integrate those winnings into their real net worth. But on the flip side, if that same person loses $200 right off the bat, they feel what we call the snake bite. They feel incredibly unlucky and suddenly avoid taking any subsequent bets at all, even if the math and the odds are totally in their favor.
And guys, this isn't just theory happening at a blackjack table in Vegas. There's a fascinating study by Massimo Mosna and Andrei Simonov. They looked at stock market behavior in Sweden and proved that this happens to everyday investors. They actually found that increased capital gains in the current year directly leads to a higher amount of risk-taking in the next year. Investors are literally treating their recent market wins exactly like casino chips. They throw all logic out the window and buy incredibly risky assets simply because they feel like they're playing with the market's money.
Wow, that is wild. So if we're out here gambling recklessly when we have these unexpected gains because of this house money illusion, what exactly happens when our investments turn red? What do we do when we actually start losing money?
That brings us to number 2, savoring gains, bundling losses. This is the emotional math of the stock market.
This right here is the dark side of mental accounting. It's all about that emotional math. See, the average person manages their portfolio not based on what makes optimal financial sense, but based purely on what minimizes their immediate emotional pain. The crucial point to understand here is the disposition effect. Human behavior is just deeply, deeply driven by the desire for pride and the absolute avoidance of emotional regret. Because of this, the average investor seeks the pride of a quick win by selling their profitable stocks way too early. But when a stock is dropping, they hold on to it for way too long. They refuse to sell because hitting that sell button makes the loss real in their minds, and they desperately want to avoid the regret of booking that loss. They're literally prioritizing short-term emotional comfort over long-term compound wealth.
And this brilliantly shows just how bizarre our mental accounting gets out there in the real world. Researcher Sonia Lim looked into the behavioral patterns of 50,000 broker accounts, and she found that investors manipulate their trades purely to manage their psychological happiness. When they have winning stocks, they savor the gains. They'll sell them off one by one across different days just to stretch out that dopamine hit. But when they're losing, they bundle the losses. They will actively choose to sell multiple losing stocks on the exact same day just so they only have to experience that emotional pain once. It's like ripping off a Band-Aid.
But sometimes the pain is just too immense to bundle, and that is when the snakebite effect takes over completely.
This happens when new investors suffer a sudden, massive financial blow, and rather than learning from it or just waiting for a natural market recovery, they completely abandon investing forever. They are literally paralyzed by the venom of their loss.
A perfect example of this is the 2008 global financial crisis. During that time, the Nifty 50 index corrected almost 60% in a span of just 11 months. Countless first-time investors who had just entered the market felt that snakebite. They totally panicked and sold everything at rock bottom out of sheer fear. They took temporary paper losses and turned them into a permanent reality. Now, the market eventually recovered and soared to all-time highs, as it does, but those specific investors, they never came back.
Okay, if I'm connecting the dots here, this all ties back to prospect theory, doesn't it? The whole idea that losing $1,000 feels significantly worse, emotionally, than gaining $1,000 feels good. We just have this disproportionate, completely irrational fear of losing.
Hit the nail right on the head, Rachel. While we all really want to believe that the stock market is this perfectly efficient, calculating machine where everything is fairly priced, the reality is entirely different. The market is heavily driven by human fear, human greed, cognitive biases, and this incredibly flawed mental accounting. We let our emotional pain and our arbitrary little mental buckets dictate our financial futures, and that creates massive inefficiencies out there.
Okay, John, you have completely exposed the traps we're all falling into. But how do we actually fix it? How do I rewire my brain right now to stop thinking like this average emotional investor and start actually thinking like a millionaire? Let's get into it. Number 3, thinking like the wealthy. It's time to break this behavioral cycle.
But right before we get to the last point of this explainer and fully reveal that wealthy framework, I need you to do something for us. Subscribe to Rich Tribe channel, like, comment, and share. We are building a massive community of rational, wealth-focused individuals, and your support helps us keep bringing you these deep dives into the psychology of wealth.
All right, so here is the exact framework the wealthy use to completely bypass mental accounting. These are 3 non-negotiable steps. First, you have to treat every single dollar as 100% fungible. Your salary, your dividends, those random crypto gains, it's all just one big pool of money. Second, never let sunk costs dictate your future decisions. If an investment is bad today, it literally does not matter what you paid for it yesterday. Cut it. And third, evaluate your entire portfolio holistically. You've got to stop putting your investments into isolated mental buckets and start looking at your total net worth as one single entity.
You know, in standard economics, perfectly rational actors are called econs. And as behavioral economists love to point out, econs never allow sunk costs to influence their decisions. Why? Because doing so introduces information that is completely irrelevant to optimizing solutions. The wealthy act exactly like econs. They completely strip the emotion out of the equation. They do not care about the pride of a quick win, and they certainly don't care about the regret of a loss. They literally only care about making the optimal mathematical move for tomorrow.
So I'm going to leave you with this final thought. Take a hard look at your own portfolio right now. If you viewed your entire net worth as one cold, emotionless number today, what losing investment would you finally sell? Stop bundling your losses, stop playing with house money, and start applying millionaire logic today. Thank you so much for joining this explainer, and stay focused on your wealth.